China has quietly reduced its exposure to U.S. Treasury debt, and the number itself is what should get your attention. According to the source material, Chinese Treasury holdings have fallen to roughly $652 billion, the lowest level cited since September 2008. But the bigger story is not simply that China is selling Treasury securities. The real story is why foreign governments are becoming less willing to increase their dependence on American government debt, and what that gradual shift could eventually mean for the dollar, Treasury yields, and most importantly, gold and silver. For decades, the global financial system operated on a relatively simple assumption. America could issue enormous quantities of government debt because there would always be buyers. Foreign governments accumulated treasuries as reserve assets, financial institutions used them as core holdings, and the dollar remained at the center of global trade and finance. But that automatic demand is no longer as automatic as it once appeared. The source material points to a major change in the share of U.S. debt held by foreign nations. In 2012, foreign governments reportedly owned around 34% of outstanding American debt. The source says that figure has now fallen below 24%. Whether you interpret that as a crisis or simply a long-term portfolio adjustment, the direction matters. The United States continues to increase its debt, while foreign ownership represents a smaller proportion of the total. And this is where the gold story begins. Because when central banks and governments decide they don't want all of their reserves concentrated in one country's debt market, they need alternatives. They can move toward other currencies, they can hold other sovereign bonds, they can increase liquidity reserves, or they can accumulate an asset that does not depend on another government promising to repay it. That asset is gold. But before we jump to the conclusion that this means the dollar is about to collapse, we need to slow down. The source itself presents a much more complicated picture. Japan, for example, remains one of the largest foreign holders of U.S. treasuries, with more than $1.1 trillion cited in the material. Yet Japan also reduced its treasury holdings during a period of currency pressure. The explanation presented is not political hostility toward Washington. It is economic necessity. When energy prices and currency markets become unstable, Japan may need dollar liquidity to defend its currency, and treasury securities can become a source of that liquidity. That distinction is critical. Not every treasury sale means a country has lost confidence in America. Some sales are tactical, some are driven by currency intervention, some are portfolio rebalancing, and some may reflect a longer-term strategic decision to diversify reserves. China is the more interesting case because the source describes its reduction as a much longer-term process. Chinese treasury holdings reportedly peaked around $1.3 trillion in 2013 and have declined substantially since then. That means we should not look at 1 month's treasury data and immediately declare a financial revolution. We need to look at the direction over many years, and that direction is what matters for bullion. If governments gradually reduce their concentration in U.S. government debt while simultaneously increasing their interest in reserve diversification, gold can become increasingly important. Gold does not carry the same sovereign credit exposure as a treasury bond. It does not depend on the Federal Reserve maintaining a particular interest rate policy, and it cannot be created simply by issuing another government liability. This is why central bank gold buying matters so much to the long-term bullion story. The source connects the growth in official gold accumulation to the broader diversification process that accelerated after the global financial crisis and became even more significant after the freezing of Russia's foreign reserves. The argument is not that governments suddenly abandoned the dollar. It is that governments became more conscious of the risks associated with concentrating reserves in assets that can be exposed to geopolitical decisions. So the question we need to ask is not, is China dumping America? The better question is, who will absorb the next wave of American debt if foreign governments increasingly want diversification rather than greater concentration? Because that question leads directly into the treasury market, interest rates, the dollar, and eventually the valuation of gold and silver. And that is where this story gets much bigger than China. Now we reach the part of this story that most headlines completely miss. If foreign governments are gradually reducing their share of U.S. Treasury debt, the United States does not suddenly stop functioning. Treasury auctions continue, bonds continue to be issued, and buyers continue to appear. The real question is not whether America can sell its debt. The question is who has to absorb more of it and what price will they demand. The source material puts the total amount of foreign-held U.S. debt at roughly $9.3 trillion. That sounds enormous, and it is, but the more important issue is the relationship between the growth of American debt and the willingness of foreign investors to absorb an increasing share of that supply. If the government keeps borrowing faster than foreign demand grows, domestic investors increasingly become the marginal buyers, and that changes the market. When buyers demand more compensation to hold government debt, Treasury yields can rise. Higher yields increase the government's financing costs because Washington has to pay more interest as existing debt matures and new debt is issued. The source material says U.S. interest payments have already moved above $600 billion annually, placing them in the same broad conversation as national defense spending. This is where the Treasury market becomes extremely important for gold. Gold does not pay interest, a Treasury bond does. So under normal conditions, when Treasury yields rise significantly, gold can face competition from bonds. Investors can ask a simple question: why hold an asset with no coupon when government debt is offering a higher yield? But there is another side to that equation. If Treasury yields are rising because investors are demanding greater compensation for fiscal risk, inflation risk, or uncertainty surrounding future government borrowing, then the higher yield itself can become part of the problem. The market may be offering investors more income because it needs a stronger incentive to attract capital. That is a very different environment from yields rising simply because the economy is healthy. And this distinction matters enormously for bullion investors. The source material also shows why we should not turn this into a simplistic "foreigners are abandoning America" narrative. Saudi Arabia reportedly increased its treasury holdings by 19% in 1 month, while Canada increased its exposure by 13%. At the same time, India and Brazil reduced their holdings. That tells us something important. This is not a synchronized global exit. It is selective repositioning. Some countries are willing to buy treasuries because yields are attractive. Others want to reduce concentration. Some are managing currencies. Others are managing geopolitical risk. So the market is not moving in one direction. It is fragmenting. And that fragmentation is precisely what makes the long-term gold story interesting, because central banks don't necessarily need to sell every treasury they own and replace it with gold. They can simply change the composition of future reserves. Instead of adding another dollar-denominated asset, they can add gold. Instead of increasing concentration, they can diversify. One purchase doesn't change the global monetary system, but repeated purchases over many years can. The source material describes central bank gold accumulation as part of a broader diversification trend that has been developing since the financial crisis. The freezing of Russian foreign reserves is presented as another major factor that changed how governments think about reserve security. And here is the key distinction for our analysis. Gold is not necessarily replacing the dollar today. Gold is increasingly being used as an additional reserve option that is much more defensible and much more important than claiming an immediate collapse of dollar dominance. Meanwhile, the United States still has a huge domestic investor base. The source estimates that roughly 78% of American debt is held domestically, including the Federal Reserve, government trust funds, banks, pension funds, mutual funds, and other American investors. The Federal Reserve alone is cited as holding around $4.6 trillion of treasuries, while intergovernmental holdings are estimated at roughly $7.2 trillion. So America is not dependent exclusively on China or Japan. That is important. But there is a second-order effect that deserves attention. If domestic institutions have to absorb more government debt while the overall supply continues growing, the treasury market can become increasingly sensitive to yields. Higher yields may attract buyers, but they also tighten financial conditions throughout the economy. Mortgage rates can be affected, corporate borrowing costs can rise, consumer credit can become more expensive, and businesses may become more cautious about investment. Suddenly, something that started as a treasury auction story begins moving through the entire financial system. And then we reach the part that could become especially important during a period of market stress: leverage. The source highlights the treasury basis trade, where highly leveraged institutions exploit small pricing differences between treasury securities and futures. If the treasury market experiences a sudden shock, leveraged positions can be forced to unwind, potentially adding selling pressure to an already stressed market. This is why I don't think the real story is simply China is selling treasuries. The deeper story is America needs enormous amounts of capital, global investors have more choices than before, and central banks are increasingly interested in reserve diversification. And when that happens, the question isn't whether the financial system collapses tomorrow. The question is how much compensation the system eventually demands for carrying America's growing debt, and whether that environment creates an increasingly favorable long-term backdrop for gold. But there is another piece of the puzzle we haven't touched yet. What happens when this gradual diversification collides with America's debt trajectory itself? That is where the pressure could become much more significant. But now we have to take the next step, because treasury diversification only becomes truly important when you place it against the size and trajectory of America's debt. The United States does not simply need to refinance old debt. It continues to issue new debt while running large fiscal deficits. That means the treasury market must constantly attract enormous amounts of capital. And if foreign governments are willing to absorb a smaller percentage of that growing supply, the market has to find additional buyers somewhere else. This is why the headline about China matters less than the underlying arithmetic. Imagine a company that keeps increasing the amount of debt it needs to refinance. While some of its traditional lenders gradually decide they don't want to increase their exposure, the company may still find financing, but eventually, lenders may demand better terms. The Treasury market works differently, but the basic pressure is similar. If demand isn't keeping pace with supply, yields can become the adjustment mechanism. And that creates a feedback loop. Higher yields can attract investors because they offer better returns, but higher yields also increase the government's interest expense. That means more federal revenue has to go towards servicing existing obligations instead of other priorities. And if deficits remain large, the government continues issuing debt, creating even more supply that the market must absorb. The source material argues that interest costs have already moved beyond $600 billion and are approaching the scale of major federal spending categories. This is where I want to make an important distinction. A high debt level does not automatically mean an imminent U.S. financial crisis. America issues debt in its own currency, has the world's largest treasury market, and still possesses an enormous domestic and international investor base. The source itself shows that foreign behavior is mixed rather than representing one synchronized exit. So the more credible thesis is not collapse, it is rising sensitivity. The financial system becomes more sensitive to changes in yields, inflation expectations, fiscal policy, and investor confidence. And that sensitivity matters for gold, because gold tends to become more interesting when investors start questioning the long-term stability of fiat purchasing power, fiscal discipline, or the concentration of reserves in sovereign debt. Now consider what central banks are doing. The source material describes central bank gold purchases as part of a diversification process that accelerated after the 2008 financial crisis and gained another geopolitical dimension following the freezing of Russian foreign reserves. Again, this doesn't mean central banks are abandoning the dollar overnight. It means they want an asset outside the liabilities of another government. That difference is crucial. A treasury is a promise by the US government to repay according to its terms. Gold is not someone else's liability. Its value comes from its scarcity, liquidity, global recognition, and role as a reserve asset. So when a central bank adds gold to its reserves, it isn't necessarily making an anti-dollar bet. It may simply be reducing concentration risk. And if dozens of countries make that decision independently over many years, the cumulative effect can become significant. This is the slow-moving process the source describes as a gradual rebalancing rather than an immediate collapse. Now let's bring silver into this discussion. Gold is the more obvious monetary reserve asset, but silver sits at the intersection of monetary demand and industrial demand. That gives silver a different sensitivity. If the broader macro environment produces stronger investment demand for precious metals while industrial demand remains resilient, silver can respond differently from gold. It can become more volatile because it is influenced by both monetary expectations and the industrial cycle. That means a structural diversification story doesn't automatically translate into identical gold and silver moves. Gold is the cleaner reserve diversification story. Silver is the higher beta precious metal story. And that distinction is important for anyone watching bullion markets. But there is another risk hiding inside the treasury market: leverage. The source highlights the treasury basis trade, where leveraged investors exploit relatively small differences between cash treasury prices and futures. In a stable environment, these strategies can operate quietly, but during a sudden liquidity shock, leverage can turn a relatively small market movement into something much larger through forced position unwinding. That creates an interesting contradiction for gold. During a sudden liquidity crisis, investors can initially sell almost everything that is liquid because they need cash. Gold is not automatically immune from that kind of pressure, but once the immediate liquidity shock passes, investors may begin asking a different question: why did the treasury market become unstable in the first place? If the answer involves excessive leverage, fiscal uncertainty, rising debt supply, or concerns about the long-term purchasing power of money, the narrative can eventually shift back toward hard assets. That is why I would not analyze gold using one variable alone. Watching only the Federal Reserve is not enough. Watching only inflation is not enough. Watching only the dollar is not enough. We need to watch the interaction between treasury supply, yields, fiscal deficits, foreign demand, central bank reserves, and investor positioning. That combination tells us much more about the long-term direction. And this brings us to the most important question of the entire story. If foreign governments continue diversifying gradually, while America's debt keeps expanding, how long can the system absorb that imbalance without demanding a higher price for capital? Because eventually that price shows up somewhere. It can show up in treasury yields, it can show up in mortgage rates, it can show up in the dollar. And under the right conditions, it can show up in the price investors are willing to pay for gold and silver. The source describes this as 1,000 small decisions rather than one dramatic event. Countries reducing concentration, central banks accumulating alternatives, and institutions reassessing their exposure. That is the part I believe deserves the most attention. The biggest monetary shifts rarely announce themselves with one single headline. They develop through repeated decisions. And if those decisions continue, the next phase could be much more important for bullion than the Treasury headline itself. Now, we can connect the entire story directly to bullion, because this is where the Treasury market becomes much more than a bond market issue. If governments are gradually reducing concentration in U.S. debt, the key question is not simply where that money goes next. The key question is what kind of asset governments want to own when geopolitical and fiscal uncertainty are both rising. And this is where gold becomes strategically important. The source material describes central banks increasing gold purchases as part of a long-running reserve diversification process. That process accelerated after the 2008 financial crisis and gained another layer of importance after Russia's foreign reserves were frozen. The lesson for other governments was not necessarily that the dollar system was finished. The lesson was that concentrated reserves can carry geopolitical risk. That distinction changes the entire gold thesis. Gold does not need to replace the dollar for its importance to increase. It simply needs central banks to decide that they want a larger percentage of their reserves outside the traditional dollar-based system. And that is a much more realistic scenario. Think about the decision from the perspective of a central bank. You already have dollars, you already have Treasury securities, you already participate in the global dollar system. But if your objective is to reduce concentration risk, buying more of the same asset doesn't solve the problem, so you diversify. And gold is one of the few globally recognized reserve assets that doesn't represent another country's promise to pay. That makes gold fundamentally different from another sovereign bond. This is why I think the most important word in this entire story is not de-dollarization. It is diversification. Those two words are often treated as identical, but they aren't. De-dollarization suggests an active attempt to replace the dollar. Diversification simply means reducing excessive dependence on one asset, one currency, or one financial system. The second process can happen without destroying the first. And that is exactly what the source material appears to describe. It says the world is not witnessing an immediate collapse of dollar dominance, but rather a slow and deliberate rebalancing in which countries want more options and less single-point financial dependence. Now bring that back to gold prices. If central banks continue accumulating gold while Treasury supply remains enormous, the precious metal market can receive a structural source of demand that doesn't depend entirely on retail investors or hedge funds. That's important because central banks are typically long-term holders. They don't necessarily trade gold because a technical indicator crosses a moving average. They can buy it because they are changing the composition of their reserves. That creates a different type of demand. But this doesn't mean gold moves higher every day. In fact, gold can experience sharp corrections even inside a powerful long-term bull market. Interest rates matter, real yields matter, the dollar matters, liquidity matters, investor positioning matters. And if Treasury yields rise sharply because investors demand greater compensation for fiscal risk, gold could temporarily face pressure from higher opportunity costs. This is why the Treasury story should not be turned into a simplistic China sells bonds, therefore gold goes straight up argument. Markets don't work that way. Instead, the real bullish setup would develop if several forces begin moving together. Continued reserve diversification, sustained central bank gold demand, concerns around fiscal sustainability, persistent debt issuance, and eventually a market environment where investors question whether higher nominal yields are sufficient compensation for inflation and fiscal risk. That combination could be much more powerful than any single headline, and silver adds another layer. Silver isn't held by central banks in the same way gold is, so its monetary reserve connection is weaker. But silver has something gold doesn't have to the same degree: industrial exposure. That means silver can benefit from a combination of monetary and industrial narratives, but it can also suffer if global growth deteriorates sharply. So if this Treasury story evolves into a genuine macro slowdown, gold could potentially have the cleaner defensive narrative. If instead the economy remains relatively resilient while investment demand for precious metals strengthens, silver could have greater upside sensitivity. That is why I don't view gold and silver as identical trades. They are related, but they respond differently to the same macro forces. Now, there is another development investors need to watch closely: the behavior of domestic buyers. The source material estimates that roughly 78% of U.S. debt is held domestically, including the Federal Reserve, government trust funds, banks, pension funds, mutual funds, and other American investors. That means America has an enormous internal financial system capable of absorbing Treasury issuance. But domestic absorption isn't free. If pension funds, banks, and other institutions have to allocate more capital toward government debt, that capital cannot simultaneously be allocated somewhere else. And if yields rise enough to attract those buyers, borrowing costs throughout the economy economy can remain elevated. This is where the Treasury market eventually reaches households. Mortgage rates can remain higher. Corporate financing can become more expensive. Consumer borrowing can become less attractive, and government interest costs can consume a greater share of fiscal resources. So, the Treasury market may look distant from the perspective of a bullion investor, but its consequences spread through the entire economy. And that creates the environment where gold becomes increasingly relevant as a portfolio diversification asset, not because the United States is about to collapse, not because the dollar is disappearing tomorrow, but because the financial system is becoming more complicated. The source makes this point repeatedly. The transition is gradual rather than a sudden crisis. And gradual changes can be more important than dramatic headlines because they allow institutions to adapt without creating an immediate panic. China doesn't need to dump every treasury. Japan doesn't need to abandon the dollar. Central banks don't need to announce that they are replacing the dollar with gold. They only need to make thousands of individual portfolio decisions over years. And that is precisely how reserve composition changes. So my base case is not a dollar collapse. My base case is continued diversification. And if that diversification continues, while America's debt burden keeps expanding, gold could increasingly function as a strategic hedge against the uncertainty created by that transition. The question now is whether this trend becomes strong enough to change the broader monetary landscape, and whether silver eventually catches up with gold as investors realize that the same macro forces are operating underneath both markets. That is where the next phase becomes especially interesting. So where does all of this leave us? The most important conclusion is that this is not a story about the United States suddenly losing its financial dominance. It is a story about the global financial system becoming less dependent on a single form of reserve exposure. China's treasury holdings have declined significantly from their previous peak. Japan continues to manage its treasury position according to its own currency and liquidity needs. Some countries are reducing exposure, while others are still increasing it. That means there is no evidence here of one coordinated global exit from U.S. government debt. What we are seeing instead is selective repositioning. And that distinction matters, because if you call this a collapse, you miss the actual story. The more important word is recalibration. Countries are asking how much of their reserves should remain concentrated in dollar assets, how much exposure they want to U.S. fiscal policy, and how much protection they need against geopolitical risk. The source describes this as a slow structural shift rather than a sudden financial crisis. For gold, that creates an interesting long-term environment. Gold does not need to replace the dollar to benefit from diversification. It simply needs central banks and institutional investors to decide that they want an additional reserve asset outside the traditional sovereign debt system. That is a much lower hurdle. And if central bank demand remains strong while governments continue accumulating debt, the argument for gold as a strategic reserve asset becomes stronger. But we also need to be realistic. Gold will not move in a straight line. If real yields rise substantially, the dollar strengthens and liquidity tightens, gold can face periods of pressure. If inflation expectations rise, fiscal concerns increase, or confidence in the long-term purchasing power of currencies weakens, the environment can shift back in gold's favor. That is why the next phase should be watched through several indicators rather than one headline. Watch Treasury yields, watch the dollar, watch inflation expectations, watch Federal Reserve policy. Watch Treasury auction demand, watch foreign holdings, and most importantly for the long-term bullion thesis, watch central bank gold purchases, because those indicators together tell us whether this is simply normal portfolio management or part of a much larger structural shift. And silver deserves its own watch list. Silver does not have the same central bank reserve role as gold, but it has industrial demand layered on top of its monetary characteristics. That means silver can potentially respond more aggressively when precious metal investment demand rises, but it can also be more vulnerable when global industrial activity weakens. So if gold is the strategic reserve hedge, silver can be viewed as the higher volatility expression of the broader precious metals cycle. That distinction could become extremely important if the global economy enters a period where monetary uncertainty and industrial demand move in different directions. Now let's return to the biggest question from the beginning. Who will buy America's debt? The answer is still plenty of investors. The United States has an enormous domestic financial system. The source estimates that roughly 78% of American debt is held domestically, including the Federal Reserve, government trust funds, banks, pension funds, mutual funds, and other investors. So the idea that China selling treasuries automatically means America cannot finance itself is far too simplistic. But there is another question that is much more important. At what yield will those investors be willing to buy it? That is the variable I would watch, because if the supply of debt keeps expanding while foreign demand becomes more selective, the market may require higher yields to attract enough capital. And higher yields have consequences. They can keep borrowing costs elevated, they can pressure housing, they can raise corporate financing costs. They can increase the government's interest burden, and they can change the relative attractiveness of different assets. This is where the Treasury market ultimately connects back to your screen when you look at gold and silver. The Treasury market may be the plumbing, but bullion can become one of the assets investors use to respond to the consequences. And this is why I don't believe the correct headline is China is abandoning America. The better headline is Global Reserve Managers are demanding more options. That sounds less dramatic, but financially it may be much more important because financial systems rarely change through one spectacular event. They change through thousands of smaller decisions repeated over years. One central bank buys more gold, another reduces treasury concentration. A pension fund changes its allocation. An emerging market government diversifies its reserves. A currency manager increases liquidity. None of these decisions individually threatens the dollar, but together they can gradually change the composition of global demand, and that is the structural trend I would continue watching. The dollar remains dominant, the treasury market remains enormous, America remains capable of attracting capital. But automatic, unquestioned dependence is not the same thing as dominance. The world can continue using dollars while simultaneously reducing excessive concentration in dollar assets. Those two things can happen at the same time. And if that continues, gold could become increasingly important as the neutral reserve asset sitting outside the liabilities of any single government. For silver, the story is more complex and potentially more explosive because monetary demand intersects with industrial demand. If precious metal investment flows strengthen while industrial demand remains resilient, silver could eventually amplify the broader bullion move. But that is the scenario, not a guarantee. So my conclusion is simple. This is not a collapse story. It is a diversification story. And diversification is slow. But slow does not mean irrelevant. If America continues expanding its debt, if foreign buyers become more selective, if treasury yields remain structurally elevated, and if central banks continue building gold reserves, then the long-term monetary environment could remain supportive for precious metals. The market may not recognize every step immediately. That is exactly why investors should watch the underlying flows rather than only the headlines, because by the time everyone agrees that a structural change is happening, a large portion of that change may already be reflected in asset prices. So watch the treasury market, watch the dollar, watch central bank gold demand, watch silver's industrial fundamentals, and watch the relationship between debt supply and the capital available to absorb it. This is not a prediction of an imminent financial collapse. It is a DYOR analysis of a structural trend that deserves attention. The real question isn't whether the dollar disappears. The real question is how much of the world wants to depend on it, and how much gold and silver investors may benefit if that dependence gradually becomes smaller. Because in global finance, the biggest changes don't always arrive with a crash. Sometimes they arrive quietly, one allocation at a time.